life, we know a lot of pain, we know a lot of sorrow. So I hope it's a pray for a better tomorrow. Yes, because what is supposed to live in the day, waiting all alone. I know it's hard to get your head right when everything's so wrong, everything's so wrong, yeah. When everything's so wrong, yeah.
Woo! Welcome back. True North, episode 49, the Investment Grade Bitcoin podcast. We are back. This might be one of the last episodes that we do in 2025. We've got a crew here today. We've got myself. We've got Mason. We've got Dan Hillary. And Ben will join us as well. We've had some technical issues today. Oh, wait, there's Ben. Let's add him in. There you go. We've got Ben. He's here. And we're going to go through quite a few things. Hopefully, we'll be able to do this relatively quick. We want to go over Bitcoin MENA. We'll give a summary of what happened there. It'll be myself, Mason, and Ben. We're all there. We can talk about it. The macro environment. Dan's done a bunch of research on this front, and we can talk through the landscape, what's going on in the future, what a catalyst look like, where are we, because there's a lot of noise happening right now at the moment. Balance sheet valuations, we'll do a little bit of a reflection of where we were a year ago, where we were 2 years ago to where we are today, and start to compare not only strategy, but some of the other smaller companies relative to the other equities that are trading in the current market. So we could start to think about valuations and if some of these things make sense, because in my opinion, some of these things don't make a ton of sense relative to the power that some of these companies are holding. And yeah, we'll see where we go. We'll get into the holidays and we'll chat through it. And now Ben has a camera issue, but that's okay.
All right. I'm here. I'll get video here at some point.
You're here.
Clear I'm rusty on these.
You are rusty. It's been a while. The people have missed you. Well, if this is your first time joining, this is True North, the Investment Grade Bitcoin podcast. We are here to talk about Bitcoin. We are here to talk about securitized finance, the future of Bitcoin as collateral, and everything that's happening behind the scenes in the credit market, the credit landscape relating to these types of instruments, and how these things are fitting into the traditional financial ecosystem. If this is your first time listening, we've got several people from different backgrounds that provide different perspectives. Myself, Dan, Mason, Ben, and the rest of our crew all just come from completely different backgrounds and see the world a little bit differently. So good conversations on this front. And we take a very analytical approach into things, and we will get into some of those stats and details a little bit later. So without further ado, I'll pass it over to Tim.
Ladies and gentlemen, what you're about to hear may be amazing, but it is not financial advice. It's for informational and educational purposes only. Jeff, back to you.
Perfect. All right. Yeah, none of this is financial advice. We are just really interested in everything that's going on here, and we've been following this space incredibly closely. So while I wait for Ben to come back on and we can talk about Bitcoin MENA, I will just start with Ben's here. He's in the chat. Oh, there he is. Okay, we got him. Okay, he made it. It's not like this is his first time or anything. Okay, so maybe we'll start with Bitcoin MENA, just some perspectives of traveling to the Middle East, talking about Bitcoin in a completely new location. I went to Bitcoin Asia a little bit earlier this year, so I've now gotten perspectives from the US conference in Vegas. I went to BTC Asia in Hong Kong, BTC Amsterdam, so I've got the Europe perspective, and now BTC MENA, which I think was the most unique conference out of all of them, just given the general landscape and the capital environment in that area. First of all, prior to going to Abu Dhabi and going to the Middle East, I'd never thought I would ever go to the Middle East ever in my entire life. It has been just a blip of desert on a map, and I've had no desire to go out to the desert. In my mind, I just thought this is oil and hot and dry why would anybody want to go there? And I was completely blown away. Abu Dhabi is one of the most incredible places I've ever traveled in my entire life. People have said the same about Dubai, and I'm looking forward to going to Dubai next time I go there. I didn't make it there. But the first thing I noticed in arriving in Abu Dhabi, just generally, the architecture was incredible. I stopped over in Qatar. The Qatar airport was out of this world. The Abu Dhabi airport was incredible. And I'm driving in, and you go past the mosque, the Grand Mosque in Abu Dhabi. And this thing is just like this huge cathedral church that is, I mean, it's absolutely enormous. It just dominates the skyline. You're driving by it, and you could see it from, a mile, 2 miles away, and it's dominating everything else around it, which was incredible. And then additionally, all the other architecture, and Ben and I and Mason even went to one of the museums there, and they've got this whole cultural area, and it's a bunch of these really large, fancy pieces of architecture that are housing different types of museums in different locations. And the architecture, completely incredible. The streets were clean. Ubers were available everywhere you could go. The amount of wealth was insane everywhere. There's Lamborghinis, Rolls Royces, Range Rovers, driving everywhere. I didn't see a single homeless person throughout my entire trip. The fact that there's water infrastructure in the entire city just blew me away. Apparently they've got like enormous desalination plants everywhere because there's no rivers, there's no fresh water anywhere. And yeah, it was just that part just blew me away. And before we even get into economics and thinking about just the cultural and economic aspect, I have very little desire to ever go back to Europe. I will be going to the Middle East. I'll be going to Dubai and Abu Dhabi to spend more time because I didn't get enough time there. So maybe I'll pass it over to you guys, Mason, Ben, and like your guys' thoughts before we even get into like the economic part.
Yeah, I mean, I'll second that. I never thought I would go to the Middle East, and the second I got there, I was like, I don't know enough about this place. I need to do some history. And what was fascinating was, in 1960, Abu Dhabi was just a pretty simple fishing village. This is before they found oil. They found oil in 1966, and obviously that place has exploded, and it made me start thinking about energy, right? And
Yeah.
the analogies that Saylor uses about oil refineries, obviously the Rockefellers and the power of condensed energy in many forms. And so that was kind of the way I was viewing the trip going into it. And yeah, I mean, this fall has been pretty crazy for me as well. I was in Montreal for the Canadian Bitcoin conference. I went down to Brazil for SatsConf, and then I went to Bitcoin Mena, and each one of them was a very unique perspective. I will say this one was very finance focused, and I think it was during Finance Week. Is that correct?
Yeah.
There was,
Yep.
So there's a lot of money in the region. There's a lot of traditional finance there, and I think that came through in the conference in that I wouldn't say it was necessarily like a maximalist crowd. It was maybe people viewing Bitcoin as a part of a diversified portfolio of assets, and I think it was a particularly good crowd for products like Bitcoin-backed debt. And I think that's really why, maybe not why, but Saylor was obviously on a crusade in the Middle East to spread the word of Bitcoin and spread the word of Bitcoin-backed debt. And I think more than anything, that audience is open to it. And I think we'll go into his talk, but I think that region is looking to pivot, right? Move from oil physical energy, potentially
Liquid. From liquid money to digital money.
And I think that's the pitch he gave them, was this region can be the next Switzerland. And that started, I was talking with some folks there. Shout out to the fella from Saudi Arabia who watches us and came up to me. That was like,
shout out. Yeah.
I was like, what?
Yeah. We've got fans in Saudi Arabia and Kuwait and Abu Dhabi,
India. Yeah. But we just started talking about what that region would look like on a Bitcoin standard if they adopt digital energy, and the potential there is massive. I'll kick it over to you, Ben.
Yeah, no, I'd echo a lot of what both of you said, but what I saw was a region that's in transition, but doing it from a really unique perspective. I mean, Jeff, I don't know how many times when you and I were looking around and you realize that what you're watching is a country be built with no debt. This is an entirely debt-free country, huge amount of excess. And now they've been using the oil money to really develop themselves, and they're looking at how do they diversify past that now. That created a huge amount of wealth. They're looking for what's that next step. And, Saylor made kind of a funny quote when he was doing, I know he did it on the enterprise stage. I don't know if he did on the main stage there, but he goes, there's a couple things I've learned about the people in this region. It's they like technology and they love money. And because of that, they were uniquely interested in what's happening here, particularly in the US markets, and looking at what's happening with digital credit and how they can bring that to their region and effectively set themselves up as a banking center. And I'm sure we'll talk about this in pretty great depth here in a little bit, but part of it is just because they have such unique characteristics in the amount of control that they have to get things done.
Tons of control.
So that blew my mind.
Flexibility and control. Yeah. And they could act quickly.
Correct. Yep.
Yeah.
And so getting something done in the US, obviously there's a lot of bureaucratic tape, and I've spent the better part of this week out talking to governor candidates and congressional candidates and talking about Bitcoin. And so you see the amount of friction that there is in the system, which, I think is good. You need the checks, obviously. I'm pro USA here. This is my home. This is what I love. But when you see a different model, you understand why they can be so effective over there. And I think that's why you saw Saylor spend so much energy canvassing that region, right? Every day he was in another part of that region. He was talking to the sovereign wealth funds. He was talking to the banks. He was talking to everybody, and really taking advantage of that time that he had there to show them, listen, there's this revolution in capital happening right now. And you guys have the unique structure and the unique capability to stand up the infrastructure that the rest of the world is going to use here over the next 100 years. And I think that was the pitch that he was really starting to make. And my hunch is that resonated quite deeply, because it's a natural evolution for that region, going from, like you said before, right, a liquid commodity to a hard digital commodity here. While you've still got the wealth coming in from all the oil, you've still got that supporting everything that you're doing within your country. And now you take the next decade to transform yourself into that next layer where you're now a primary finance hub for the global economy. And I think that's what you were starting to see. So it was really fascinating, because the energy was just different. They just viewed things different. And I think they do that because they don't have the friction. They know if they choose to move, they can do it. And so it's a different type of optimism that you see. So I agree with everything you guys said. We had a great time in Abu Dhabi. It was beautiful. It was clean. Everyone spoke English, so I could go to obscure small cafes and no issues. I had a way better time than I expected to. You don't know what to expect your first time going into those regions. But the other thing you reflect back on is, look at where all this brought us, right? Like, my gosh, who would have ever thought that we started talking on the internet late at night on Wednesdays, and all of a sudden a bunch of us are in Abu Dhabi at these conferences? Like, it's a wild ride.
You got to pinch yourself.
Yeah, it'll blow your mind. It really does. But it's been a really cool experience.
Yeah, I think one interesting comparison, and I heard these statistics. So Ben, you hit on apparently that region has no debt. I think it's very little debt. I think they're like 20% debt to GDP, where the US is like 140% debt to GDP. So the balance sheet of those countries is like completely flipped to the financial strength side. And when you compare it to the US, I mean, just based on what I've observed in the US, there's a lot of strife everywhere. But I didn't get that feeling in the Middle East. And I went and played golf. I got a round of golf in before I went and got on the airplane to take my 24-hour journey home. And I got paired up with a couple local guys, and the locals were expats. So one was from South Africa, the other was from the UK. Both of them are primary school teachers, so they teach elementary school. They had both moved their families to Abu Dhabi, and they're happier than ever. And they were playing golf on like a Wednesday afternoon, like in December. And meanwhile, I'm like, my brain can't compute. Like, what do you mean you moved your entire family here, and you're a elementary school teacher, and you're getting by and playing golf? I just like I couldn't. My brain couldn't compute that being a possibility. Like, if you're in elementary school here in the West Coast, like your life is miserable. You can't afford to live. Like, you probably don't have kids, but you're teaching kids, and let alone getting out and going to, play a recreational sport is probably not a thing, because you probably have a second job. So it was a fascinating perspective on the landscape of the area. And additionally, the ability to move quickly. Apparently during COVID, when all the lockdowns were happening, they opened their borders. They're like, everybody come hang out in the Middle East. And a lot of people fled from like the UK and these different regions, and they've just never left. They really enjoy the quality of life. And there's money to be made there because there's a lot of wealth there, and there's jobs and different opportunities everywhere. Also, cranes everywhere. Like, cranes absolutely everywhere. Like, the skyline is dominated with crazy architecture and just building as far as the eye can see. So it was just a very, very interesting glimpse of what a modern, like, more of a hard money society could be built like, or what it could look like, backed by prosperity and potentially storing your energy without decay, like in Bitcoin. So yeah. Okay. Anyway, let's go on to next topic. I think that was a great overview there. And maybe let's switch gears, and we'll talk a little bit about strategy, just statistic update. And then Dan, we'll kick it over to you and go into macro, think about macro a little bit. And then we'll look at and think through strategy and this digital money concept and everything that's moving on that front, kind of that presentation in Abu Dhabi, and we'll go from there. So, going to share my screen, and this is what we do nearly every week, and I'll put you guys over there on the side. So on this column here, column BS, we're deep in the spreadsheet now. Column BS, the date 12/17/25, Bitcoin held, strategy holds 671,000 Bitcoin, Bitcoin price $86,000. MSDR price of 160. Boo. Would love to see that go higher, but it is what it is. The Bitcoin assets held on the balance sheet, $57 billion. The USD reserve, $1.4 billion. Debt, $8.2 billion. Preferred stock, $7.9 billion. So the net capital held on the balance sheet is about $51 billion. If you look at the net capital held on the balance sheet at the beginning of 2024, it was $5.7 billion. So a 10x growth in the net capital held on the balance sheet. The leverage ratio around 12% and the amplification ratio around 27%. So again, balance sheet is incredibly healthy here. Bitcoin price needed for assets to be worth less than the debt is 12,000. So there would need to be an 86% drawdown in order for the assets to be less than the debt. And that wouldn't trigger a liquidation. Like, liquidation doesn't exist. The net capital would provide 62 years of the pref dividend payment obligation, so 824 million. That would take us to the year 2087 with Bitcoin payments, assuming Bitcoin did not move another dollar from here until then. So incredibly healthy. Then I put these two columns in here to showcase a 50% drop and a 70% drop from here and what that would look like. And I think this is an interesting exercise, because even from here, if you were to think about Bitcoin dropping 50% from here, going down to 43,000, the leverage ratio on the balance sheet would still only be 23%. Still an incredibly healthy balance sheet. And the total amplification would be 53%. They would then have 27 years of net capital to cover the dividends, which would take us to the year 2052 of dividend coverage if Bitcoin didn't move up another $1 from 43,000. So I think this is helpful to look through, just continuously understanding the strength of this balance sheet. And I'm going to share a clip real quick and do a quick look back based on how we got here. This is the original, one of the original Quant Bros, and we'll talk through this. This will lay the stage for the next piece here. I think that's one thing that the investing community on Twitter or X seems to miss, is that they think in the future that MicroStrategy will have to sell their assets or sell the Bitcoin in order for it to be used or to generate value. But in the future, they will be able to use that entire portfolio of assets as collateral to generate cash flow, to increase operations and increase revenue and increase future cash flow down the road. That pile of assets is not going to be sold. It's going to be used as collateral. All right. So that's where we're at. We've got a huge pile of collateral and it's starting to be utilized, and we are seeing digital credit expand in front of our eyes. And, you know, I think it's helpful to take a look back and see, like, where are we today and where were we back in March of 2024 when we put together that video, that presentation. So Strategy held 193,000 Bitcoin in March of 2024. And the market cap, or the value of that Bitcoin, is about $11.9 billion. And the market cap was 18 billion. And the next closest company was Mara, and they held about 17,000 Bitcoin. So they had 11 times multiple over and above the next closest competitor that was publicly traded. Now, fast forward today, they hold 671,000 Bitcoin. So that's increased about 250%. They've gone from 0.9% of the network to 3.2% of the network. And the next closest publicly traded competitor holds 53,000 Bitcoin. So they have increased the lead over the next closest competitor. And the thesis is really unchanged here. Like, I liked it then. I still like it now. And I think we're really in early innings of the development of this digital credit model and utilizing this stuff as collateral. And we'll get into some of the use cases here down the road. And before anybody says, well, but the dilution, the shares outstanding have increased 81%, yet the Bitcoin held has increased 248%. I'm happy with this. I'm holding this for the long term. This is so deep into my portfolio. It's the furthest thing in my entire portfolio from the sell button. Like, I want to give this the time so it can run its course and we can see what the future of this looks like. Again, none of this is financial advice, but this is collateral, right? You've got a company that's gone from, $500 million to $58 billion of capital that can be used as collateral in different ways. And, we've seen them now at banks. We've seen Saylor running around the Middle East at different countries talking to, central banks. And this is, we're just getting started. So yeah, I'm happy here. I'm bummed about the stock price, but I love the fundamentals. Like, the fundamentals look so much better today than they did in 2024.
Yeah, I mean, you're going to go on this emotional roller coaster anytime you're building out a new industry, and given the volatility that you're going to see in Bitcoin, that's going to play to emotions over and over and over again, right? And what I like about that clip that you played, Jeff, given how far back that was, which actually wasn't all that far back, it just feels like it now, but
felt like a kid.
Yeah. It's nostalgic.
I watched it. I'm like, oh my God,
that's your origin story right there, right? And you look back, and that was always kind of the thesis. The thesis was, over time, you're going to have more optionality for how to deploy Bitcoin without even having to get rid of it. The thesis had always been it was going to start getting ingrained in the financial institutions. And I remember even in some of our very earliest conversations, you're going, just imagine they build this massive stack and they get 1% bank interest on it. right? And what do you think Saylor's doing at these banks? Right? This shouldn't be too hard. You don't have to follow that thread too far to figure out why they're all talking to him right now. Right? The OCC kind of gave them the air cover, and you're starting to see the regulations. They just continue to ease. You're starting to see more adoption. You're starting to see more global adoption. You're seeing central banks picking up Bitcoin, right? The financial institutions are going to want to participate, because if you don't, you got to think about what happens. Right now, the way people are using Bitcoin a lot of the times is they're using it as an off-ramp from their bank accounts. I no longer want to put my savings in a savings account that yields me, 0.1% or 0.2% or 1% even. They're offloading that into Bitcoin. So if you're a financial institution and you're seeing capital move somewhere else, and that's the capital you depend on to be able to lend, to scale your business, over time, as you see it start winning and it becomes a $1 trillion asset and a $2 trillion asset and then a $5 trillion asset, you want that asset inside your bank. You want to be able to provide the services. Now, even at this point, I don't think the banks have, clarity in terms of what the treatment will be from a balance sheet perspective. Right? I think that's probably what they're pushing for, to find out if there's a way where if someone's willing to custody their Bitcoin with the bank and give them the rights, is there a way for them to deploy that? I think that's probably what they're looking at right now. But on the path to that, what you want to do is court the largest concentrated position you can get your hands on in that strategy. So I think we're entering that next phase here, where over the next 12 months, you start to see those services. You already know that trading services are coming to the banks, right? Those have been announced at several of the major financial institutions. So that part's coming. They're already starting to trade with it, which is good. But now I think that they're starting to see that this is happening. And they fought it for a long time, pretty actively. Right? I mean, kudos to JP Morgan for the chaos that they sowed over and over again. They did a pretty good job at that. But it feels like we're getting to that capitulation point. And that's going to open up a huge amount of, one, it's going to bring people who aren't deep down the rabbit hole. It's going to bring them better capabilities to hold and custody it, because they still trust the traditional financial institutions. It's where all their checking account cash is held. It's where most people are going to have their savings account. A lot of them have integrated brokerages with their banks. And because of that, it's a very familiar place that they've trusted for a long time. They're comfortable there. So if they can buy Bitcoin through that channel, that's probably what they'll do. And now you got to imagine if there's a way for banks to deploy and use this Bitcoin as a part of their balance sheet, and they can actually offer you a yield on it. Now you're going to entice people who are even probably very staunchly in the cold storage category right now. If you've got someone holding a massive amount of Bitcoin and they can just sit it idle in a bank and they'll pay them 1 or 2%, do you think a lot of people will do that? Probably. Right? Probably. And so I think you're starting to see that shift. And that's kind of been the thesis here for a while, is pile up capital, do this for an extended period of time, remain consistent in that, continue to accumulate. And what happens in 20 years when you've got $100 billion? Well, that's probably way too low when you're talking about strategy, but $200 billion of capital. What can you do with $200 billion of capital?
You mean 10 trillion?
$10 trillion of capital. Sorry, yeah. Bearish, I guess. But just make it a number you can understand. $200 billion of capital. Let's just say that's it, right? 200 billion. What can you do with 200 billion? Jeff, you track the S&P 500 all the time. How many companies in the S&P 500 have market caps higher than 200 billion?
Oh, yeah.
Any idea? It's not many.
Yeah, 20 maybe.
Yeah. The answer is you can become whatever you want to be. They may not need to become anything other than what they're doing now. They're becoming a structured finance company. That's what they're becoming right now. But you have that optionality, and that optionality has value. I don't think it's reflected today, but it's a reality that capital has value in the optionality it brings you as an organization. And we don't know what 10 years from now looks like for Bitcoin. Look at the infrastructure that's been built since we started doing this. Look at all, I think we forget it. We need a list of everything that's happened, the big developments that have happened since we just started doing True North. because it has been so fast that we're almost not even surprised by it anymore.
It's breakneck speed. It's like
I remember the days when I thought the day that a company gets involved, oh my gosh, right? Well, now we've got 200 companies that are involved on this. You've got central banks that are involved in this. You've got countries like El Salvador stacking this. You've got people in Africa spinning up businesses around this. It's all over Europe now. It's obviously massive in Japan. You've got all this regulatory clarity that's come out. You've had banking regulations getting rolled back. You've had a tax that came on Bitcoin that then went away. Like, you've got a friendly US administration, which I never in a million years thought was going to happen, right? Like, it's winning. Bitcoin is winning. That's what's happening right now. And it's happening so fast that we just look past it at this point. We almost view it now as a foregone conclusion that it's going to win. But when it starts to win, and when these regulations pull back, and when these businesses get clarity on how they can utilize the asset, that's when the businesses are going to be spun up around this, where they can integrate that asset. And that's coming in the next 1, 2, 3, 5 years. And those rails in 5 years or 10 years are going to be completely unrecognizable from where we are today. I believe that deep in my core, that is what's going to happen here, that what happened in the last year is going to feel like nothing happened, even though basically everything we could have asked for has happened now. So, I keep getting pumped up about all this, because even when I've been talking to these politicians, right, and they're all at very different stages of their journey here. And some of them come in and they're basically, there to talk to you, to tell you how wrong you are and how they need to fight against this. And then other ones realize that it doesn't necessarily need to be at odds with the US at all. Like, it can be complementary. It can be a hedge for the United States. It doesn't need to be the core of what the United States is trying to build on, because the United States right now has the reserve currency. What you're doing is you're protecting against a future where you might not. And they're starting to see that it's not necessarily an either or. It's not like Bitcoin has to win at the expense of the US dollar. That's not what needs to happen. And so every time I have these conversations, I leave when someone, seems like they're starting to get it a little bit more and realizing that there's a future that looks pretty bright, even though we're on a bleak path, where you can integrate something like Bitcoin in and you can bring massive value creation that you can't see today in our current system. You can't conceptualize it from where we're at. So, So anyway, having a massive amount of capital as a business, as a strategy, one, they're going to be on the front edge of every request. Anytime someone's thinking about a service, they've got the pool of capital that these businesses are going to want to tap into, to utilize, to be able to deploy. So if you're thinking there's anybody out there other than Strategy that sees with pretty good clarity where this is moving, you'd be wrong. That is the targeted pool of capital. You can't go to the ETF providers for capital like this. You can't come just deposit this and let you do whatever you want, because they've got a whole different charter around that ETF, that structure for what they can and cannot do. But a business is different. An unencumbered business is very, very different.
The world's moving so fast, and everything's just like catching up. It's like tape delay. You've got all of these positive things happened, and then humanity needs to get itself in gear to actually build on top of that. And like, that's everybody is building on top of all of this positive stuff that has happened. And it's mind numbing how many conversations we've had, people coming to us. Like, we're not even going to people are coming to us with business opportunities and things that are developing on the Bitcoin rails and in the Bitcoin ecosystem around this environment. It's pretty incredible. Dan, I want to get you plugged in here, and let's shift to macro for a few moments so we can get some macro landscape of, like,
Can I
jump in there, Mason? Go ahead.
I just have one comment, and it's pretty simple. So Saylor has been posting all these pictures at different banks, and it got me thinking to a quote he had in 2023, where he said, there's 3 things that need to happen for Bitcoin to go to $5 million. And two of them happened in 2024, the Bitcoin spot ETF, and then fair value accounting, the FASB rules. And the third one, which he's now actively predicting that it's going to happen next year, is banks custodying and lending Bitcoin. And I think it's really interesting if you look at just kind of price action this year. 2024 was, parabolic, with the catalyst of the ETF, with potentially fair value accounting. You had a flood of companies coming in as well. And this year, there has been a lot of, general adoption, but as for big catalysts, maybe not so much. And I really think, and he's calling his shot, and I think he's actively showing this on X, is he's going to the banks, he's convincing them, he's having these conversations, and he's saying it's happening. It's going to happen next year. And I think that's huge for a few reasons. Number one, the incentive to sell Bitcoin. Why? Like, why would you sell it? At the point where you can give it to a bank and take a loan, and potentially the banks are fighting each other for your Bitcoin. Why would you sell it? Number two, and this is something he said in 2023, which is, if you're Apple and you can call up your bank and say, hey, buy $5 billion of Bitcoin, and it's simple, and it's maybe not, you don't have to go to an exchange or
a new company that you've never worked with before, like a Coinbase or a Kraken. Or
yes,
any of those. You don't have to go interface with that company.
No, it's again, it's just another super highway for capital to move into Bitcoin.
Mm-hmm.
And I think it's huge. And Saylor in many ways has been prophetic about these changes. And I truly believe like these three things are foundational for the next decade, and we will build from there. So I really love that you pulled that clip of Capital, because I think we're all starting to think about that. Like we're seeing them interact with the banks. We just came from the Middle East. His thesis for strategy is more clear than ever, in that they are issuing digital credit, and he's inviting banks to do the customer facing, the actual interactions, and they are kind of just the dealer of that digital credit for it to be implemented in many ways. And it's not only banks, it's stable coins, it's crypto exchanges, etc. So I mean, again, it's more clear than ever. They're in a stronger position than ever, yet sentiment is at all-time lows. and it's simply because Bitcoin has just been in this consolidation range. Frankly, not much has happened other than positive catalysts.
I will say it's a little weird seeing the disconnect between all the work that's happening behind Bitcoin and the layers being built above it, right? So you had Bitcoin, you've got digital credit that's come out. Now you've got layers being built on top of digital credit. And so, sitting in the seats within organizations, like many of us are, you hear those conversations. You're hearing about the businesses that are being built. You're hearing the ideas people are coming up with for how to utilize this as a real business idea that has real potential for scale. And so when you go on to X and you see a lot of, doomsday posting, and you got a lot of that going on, but you're watching the economy get built behind the scenes. It puts you in this weird spot almost where there's this total disconnect between what you're seeing in your day-to-day, and you're going, listen, price doesn't always reflect value, right? I can't remember, was it Munger or one of those guys who said all that price tells you is the price, right? It doesn't necessarily tell you the value all the time. I think that's where we're at right now. Obviously, things got incredibly euphoric at one point. We had our blow off top. Probably the only thing that had a full cycle this time was the treasury space, right? Bitcoin didn't get its massive blow off top here, but the treasury space seemed to have. But now it's gone the other way. And I think people are discounting the amount of capital and the amount of man hours that are being put into building industry around this, which is going to be incredibly important, right? This is that next level of applications that are getting built on top of all this infrastructure. And it's still incredibly new infrastructure, right? Bitcoin was the base layer of all this. Digital credit, there's only 3 issuers of digital credit, only 2 public issuers of digital credit. And so that is still scaling out. And just the fact of the structure of that security gives you other optionality for how you're going to be able to utilize this. But now you're hearing everyone building on top of that layer and how they can utilize digital credit and bring really unique structures out into the market and serve different industries. And so you see what happens with everyone who's just focusing on the equities market right now and getting really bummed out, which I get, right? We all think the prices should be way higher than that. This is one of those massive disconnects in value, probably one of the largest disconnects in value that I've probably seen personally in a while. But on the other side, you're going, but this, like all of this is happening right now.
Yeah.
It's all being built. And it's going to take a little bit of time for this to make it out there and start to scale. But when it does, the areas that it's plugging into the financial system has massive, massive unlocks for capital that can flow into this. And so to me, it gives me a huge amount of confidence to just be willing to sit and wait on my personal investments, right? Like I can see what this potentially looks like in 5 years, which is really where I'm looking out to.
Yeah.
And I don't see a scenario where this doesn't run. What you are learning is some structures are better than others. And I think the market's learning that, and even the companies are learning that. And you started to see that recently, where you're starting to see some of the breaks with the maturity risk that can be put onto a lot of these balance sheets. You're starting to see that. And so I think that anyone new that comes into this, or anyone who scales, or anyone who sheds their, maturity-based debt products, is going to be shifting over likely into this perpetual preferred market, just because that gives you an enormous amount of operating flexibility without that bullet maturity pressure that people are going to be watching for. Because I think you're even going to start hearing that noise kick up on strategy soon, even though it's so immaterial to that balance sheet, right? What was it? 8.2 billion, something like that, Jeff?
Yeah.
But right now, only one of those is beyond the conversion price. And that conversion price is like 140, what is it? 149.77. So they're in striking range of having all of those be below the conversion prices. Now, it's completely immaterial because you've seen how much capital they're raising in a week, right? It's not a problem, but it creates noise, and noise gets loud. We've seen that. And so I'm not thinking that that's not going to become another one of these topics that becomes really noisy once again, as soon as you start. If things don't turn around, people will start focusing on the fact that other treasury companies have had issues with maturities they had to manage. Strategy still has maturities out there, and if they can't equitize them, what do they do? Well, it might take them 4 days to raise the money to pay it off, I guess, but like they'll be fine, right? They're going to be okay.
Yeah, the first put date is 21 months from now.
Yeah, exactly. Yeah, it's 2027, right?
Yeah, 27, 9 months. Yeah,
yeah, 950.
So one thing interesting you laid out there, Ben, is that Strategy and these other Bitcoin treasury companies have plugins of capital that they can plug into the economy in different ways based on how the infrastructure and everything's being designed around it. But meanwhile, you look at all of these AI companies, and they're getting all of this investment on a promise. Now they have to go deliver on the promise. And it's interesting seeing the bifurcation of like these multiples expanding on a promise of an opportunity. Not to say that, AI isn't incredibly valuable. It's going to change the way the world works and all this other stuff. But there seems to be, and Mason, you've probably watched this on Jordy Visser's podcast. Like we're going to see a shift into hardware. Like we've almost reached the maximum capacity of what the software can do. Now we need more chips and hardware and infrastructure. And in order to do that, we need capital, we need money. And so we're probably going to see a lot of IPOs in 2026 of these companies that look coming out to raise capital in order to build the hardware, build the infrastructure, and deliver on these promises. And there might be a gap in time between when what they say they're going to do and when it actually can occur because of all of the hardware that needs to be put into place over time. So his thesis, which I love Jordy because he's like a meta podcast, right? He listens to all of these podcasts and he provides you an overview of all the podcasts that he listens to. And so it's like one source for a ton of information. And he just continues. He doesn't bring up strategy at all, which is I think is fascinating. Would love to get his take on it, but he just hammers on. He just hammers on balance sheet. Balance sheets are going to matter in 2026. And it was cool hearing him say that because, you know, these companies are balance sheet companies. They have money, they have capital, and people are looking for capital. So, Dan, I got to get you involved. Let's do this. What's your thoughts? What's cooking here?
Mason, were you referencing the Natalie Burnell podcast that he was on? He actually just gave his take on strategy recently. On
really?
A Natalie Burnell episode. Yeah, it was pretty good. I mean, it's the same layout. He thinks like the digital economy, if AI is in fact deflationary, which like I think a lot of us believe. There was a Dylan Patel interview this week that came out. He's essentially arguing that open source models are going to completely take the market from these kind of big frontier labs. And if that's in fact the case, right, like they're not going to get a return on their investments, and multiples will compress across the board. And that inflationary environment should theoretically be matched with a that deflationary environment should theoretically be matched with a deflationary monetary source. And so like that's where Bitcoin comes in. And then, you know, we already saw the transfer payments to US soldiers. I don't know if you guys saw that come out today, but US soldiers all got, I think it was $1,667 or something in payments that are already being shipped to all US soldiers. So like you're starting to see transfer payments back into the works. I have a couple charts of quantitative easing. Like this is QE5, which started last Friday. So like the thesis around monetary policy and fiscal policies continues to be exactly the same. And we've been in a period of tightening. So yeah, I'll share my screen, Jeff. That's cool. I have a couple of docs I want to
throw it up.
And I think, you know, we should all talk on this doc a little bit. I'll just give an overview.
Can you zoom in a bit?
Yeah.
Expand.
Enhance.
That's going to do.
There we go.
So the quote is a Hal Finney quote from Bitcoin Talk Forum. Actually, there's a very good reason for Bitcoin-backed banks to exist, issuing their own digital cash currency redeemable for Bitcoins. Bitcoin itself cannot scale to every single financial transaction in the world, be broadcast to everyone, including in the blockchain. There needs to be a secondary level of payment systems, which is lighter weight and more efficient. Likewise, the time needed for Bitcoin transactions to finalize will be impractical for medium to large value purchases. Bitcoin-backed banks will solve the problem. They can work like banks did before nationalization of currency. Different banks can have different policies, some more aggressive, some more conservative, think leverage ratios. Some would be fractional reserve, while others may be 100% Bitcoin backed. Right now, we're not fractional reserve. We're less than 100% backing. It's the reverse.
20% of not even 1-to-1.
Interest rates may vary. This sentence in itself is quite interesting. You look at the rate on SATA versus Stretch, right? Interest rates may vary. Cash from some banks may trade at a discount to that from others based on the collateral they hold, essentially. I believe that this will be the ultimate fate of Bitcoin, to be high-powered money. This was used in Saylor's speech at Bitcoin Mena, that serves as a reserve currency for banks that issue their own digital cash. Most Bitcoin transactions will occur between banks, think ATM issuance, buying of Bitcoin, to settle net transfers. Bitcoin transactions by private individuals will be as rare as Bitcoin-based purchases are today. So, I mean, this I think is an uncanny
it's profound
relative to exactly what's going on in the market right now, right? This idea of cash issued by banks is effectively what Saylor has created and what you guys at Stride have created with these kind of digital credit stabilized, floating interest rate notes, preferred products. So love to get your take there, guys.
Yeah, absolutely. And effectively what we're seeing is that the strategy is issuing digital credit, and digital credit can be almost effectively the engine that powers a stable, high yield money supply. And that's what that's what Saylor had talked about on stage at Bitcoin Mena. I think it's a really fascinating concept. Right now, for example, Stretch has a volatility of something like 7. So it's difficult if you wanted to use it in payments because there's volatility. Okay, well, it also has a 10.75% yield, which is so much better than anything else in the market. I've got like excess yield where I can take some of that yield off the top and manage the risk associated with stabilizing the volatility. Just effectively what Strategy is doing with Bitcoin, taking a 50 vol asset and turning it into a 7 vol asset with digital credit. Somebody can take digital credit and turn it from a 7 vol asset into a 0 vol asset. And that could be done with a large balance sheet from an institutional bank. This is the iPhone moment, right? You have an iPhone and you have an application on your iPhone. You have Venmo, you have PayPal, you have Instagram. These are all applications that were built on a platform. Digital credit is a platform that can be built upon. And I think that's kind of what's come through here with this quote from Hal Finney, but also what was very clear in what Strategy and Saylor were presenting in Bitcoin Mena.
Totally agree.
Yeah, I mean, I have a little bit of a different perspective because I do see a world in which people are transacting peer-to-peer with layer 2s like the Lightning Network. But yeah, I mean, I see these preferreds or Bitcoin-backed debt as just a way of easing people into the benefits of Bitcoin and stripping the volatility and, allowing very smart companies who want Bitcoin to execute this trade at scale, which is short fiat, long Bitcoin. So I think it's interesting. And today, Dan and I were talking about the end game of like, what, if you believe in Bitcoin backed debt, like why would you ever buy a treasury, right? What happens there? But I think at this point right now, they're not even in the same market, right? I think Saylor stated that what Bitcoin backed debt is competing against is junk bonds or private credit or just shitty corporate bonds at this point.
High yield credit, which is a bit different than being like a transactional layer. And I really like this slide, and I screenshotted this. And this is something that I think would be discussed at a bank, right? If you got a company that's got a very large balance sheet, you can start to offer very attractive savings products that are powered by digital credit. So on the left-hand side, you see at the asset side, right? You've got the orange bar, which is digital credit. You've got a currency, so that red block, let's just assume that's a money market fund. And then you've got a cash reserve, something that sits on top of it. So if your liabilities are over on the right-hand side, that green bar, you've got some excess buffer where you can mitigate the volatility of the digital credit instruments. And I think, they're going to try to get that volatility as possible, and maybe he will be successful in that. But I think that there's going to need to be some risk taking that occurs behind the scenes to offer, attractive products. So for example, right, like I have a bank account. The current rate on my savings in my bank account is like 0.01%. A bank can now offer me 4%. If they have some infrastructure like this, they can now offer me just greater than that. They can offer me 2. If a bank offered me 4, maybe I'd move my savings. I believe in Stretch, so I'm fine with that. But, if you interface with JP Morgan and all of a sudden they come out and they're offering 4%, 4% savings account, and they have some infrastructure that's sitting behind it, and they're taking on the risk of delivering you that 4%. But they understand that Stretch is going to give them 10 points, 10.75. They got a buffer with the currency, the money market fund, and then they got a cash reserve on top of that. They're fine because they have a buffer in that risk that they're taking. So I think this is a very attractive opportunity to offer a high-powered savings account backed by some of this stuff.
Yeah, I think he's swinging for the big idea, obviously, right? When he was pitching this at MENA, he had the big idea, the biggest idea, the bigger idea, and the biggest idea, and this was the biggest idea. And I think it is because he's targeting this effectively on a nation state level, right? He's not suggesting that a community bank go try to put this structure in place and offer bank accounts, right? He's trying to say, listen, we'll just use the UAE as the example here, right? So when he's out here talking to Abu Dhabi, he's going, you guys have control of a country. I don't have control of a country. You have a bank that you own. I don't have a bank that I own. You have influence over the regulations and the policies within your country. Great. You have a sovereign wealth fund for your country. Great. With that recipe, you can build this model. You can build the fund within your borders that backs this idea for a digital bank. And it's a really massive idea that he threw out there. And it is unique, I think, to that region largely, because I don't think a lot of other countries have that type of control. But that being said, this type of a model that he's displaying here is going to funnel down to smaller applications. Like one of the things that I've
hundreds, thousands
at like the state level is thinking about how you can work digital credit into revenue bonds and start finding ways to generate additional capital for the state, where you can now offset things like property taxes. You can do property tax cuts, but you can offset that revenue with these revenue bonds where maybe you're paying 7.5, you're getting 10.5 on a blend, and you've got a 1% cost and you're collecting the net revenue out of that spread at the state level and continuing to fill the coffers, right? Like there's ideas for how you can integrate these, and that's just one, but there's a ton of ideas. And so this digital credit layer on top of this, when you strip out, the volatility and a lot of the risk profile, opens up a huge amount of applications people will be more comfortable implementing on a short time frame.
Yeah.
And ultimately, Bitcoin will become a part of all of this, right, natively. But in the early days, it's a lot easier to go sell a committee using securities than it is this commodity that they're unfamiliar with. They all understand what a fixed income product is.
Totally.
Right. That makes sense to them. They can underwrite the risk on the company. You still have to underwrite, the Bitcoin risk at the balance sheet level. But if the state was going to do something like this, they're effectively creating their own policies for the strength the company would need to be at in order to be included in something like a revenue bond at a state level, where they would say the company would have to be 3-to-1 over collateralized, blah, 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 right? But all the whatever conditions you want so they can have control. So there's a huge amount of applications that you're going to be able to bring to market with this. And the one that Saylor pitched, which is effectively, hey, you want to recreate, the Swiss banking system in a digital age? Here's a way that you can do that, and you can attract capital, from sovereigns, from massive corporations, from high net worth individuals, because you'll be able to offer them 8% everywhere else they're going to get sub 5, right? And that's a massive idea to attract trillions of dollars of capital into your borders.
Yeah, huge. And this idea is so massive. And you said maybe a community bank's not going to do it, but why not? Like a community bank could also run some similar type infrastructure, and the people that integrate this stuff are going to succeed and prosper more than their peers. And then the question is going to be like, well, why are those companies prospering more than mine? Why is insurance company A, running a 95% combined ratio when all the other insurance companies are running a 101? What are they doing? Like, we all have the same underwriting algorithms. Like, it's the balance sheet that's performing better. Okay, so what are they doing differently for all 80-20 bonds and equities? It's like, well, we actually have this high performance digital credit on our balance sheet. And, that success starts to snowball, and it gets integrated in many places. And I think it's going to take some time, but there might be infrastructure behind the scenes in the future where we don't even know this stuff is plugged in.
Yeah, I think the limitation that you see within the US when you're talking about is that they would need to relax the requirements for how much you're allowed to hold on the balance sheet. So like right now, it's an incredibly small percentage that a bank would be able to hold in these types of equities.
Unrated.
And so you can't, really get that full benefit.
Yeah, 100%.
Having even like say you had a 5 or a 10% position, maybe it's only aligned to one specific product, right? They might be able to charge a higher annual fee on this type of account because we're going to give you a higher yield because that's the one that's tied to this asset, blah, blah, blah. But so I think there will be ways to do it, but those types of regulations would need to be removed or relaxed first.
Yeah.
I think that would be the main hurdle. And
Totally.
It's not a big one. But I think there's going to be a huge amount, particularly given the weakness that we had, within recent memory in the banking system, even though it was a while ago. People are going to be hesitant to relax regulations on banks, particularly when it comes to opening up and allowing, Bitcoin or Bitcoin derivatives to make its way in there.
Have you heard of mortgage-backed securities? Yeah, we're doing it with Bitcoin.
Get out of the door. No income, no job, approved. It's close.
Did you guys see the Besson quote from today? These 2008, 2009, 2010 financial rules were too tight. They hamstrung the American financial system. It was time for a change. We're going to be safe, smart, and sound in terms of our deregulation, but we have to take the financial system out of the straitjacket. This substantial increase in private credit, which is outside of the regulated banking system, that tells me the regulated system is too constrained. So they're doing exactly as you said.
I think
the training wheels off.
Wow.
Let it spin. Let it go.
What?
Yeah, something I was thinking about was, we've had conversations about what are the companies most likely to add Bitcoin to their balance sheet or go on a Bitcoin standard. And it's these founder-led majority stakeholder companies. And the same thing's true with countries, right? If you have a majority shareholder country or some kind of monarchy, they can implement this so much faster and without the bureaucratic headache or red tape that otherwise would be there. And if they do this, the first mover advantage, like Saylor is absolutely right. If they listen to him, they will be set up for, it will be the next global financial hub.
Generational reigns.
Yeah,
for centuries.
Yes.
Yeah. Everybody will want to do business there. It'll be the Switzerland of the new world.
Mm-hmm.
And I think Bahrain is already kind of treated like the Switzerland of the new world. A lot of the UAE companies set up in Bahrain because it's like a little bit more flexible and a little bit easier to do business there. So, it doesn't take much. And just knowing that there's all of these regulatory hurdles in the way elsewhere, like in the United States, like these countries can get so far ahead so quickly.
Yeah.
Oh man, these are really big ideas. And meanwhile, Ben's having conversations with somebody that's like, how do I buy Bitcoin? It's like, how much time do you have? I need to update you of like how far along this entire industry is. It's like a $2 trillion industry, but there's all this other stuff that's happened in the last 2 years, and you should probably be aware of all of it. And here's where we're at.
It's really interesting though. And I am not a politics guy, right? And I'm sure that comes across when I'm talking to some of these guys that I've got to get more speed on like what's going on. But when you're having those conversations, it's an interesting balance because you're really balancing the desire for sovereignty at the individual level and the ability to protect yourself and not have them come after you because you choose this asset, you choose to hold it this way, right? So there's one aspect where you want to say, what I really need from you is to get out of the way, right? Just don't be an adversary. That would be enough in a lot of states. Don't become an adversary. But then the second layer is you've got to start thinking creatively about how in their position, how does this benefit them and the agenda that they're trying to push forward? right? How can you integrate some of these solutions where it becomes a positive output or impact at the state level, at the federal level, where it puts them on a trajectory where they can make some real change, which is why when you find ways where you can potentially generate additional state level revenue, that has a long-term compounding ripple effect if they can pull it off. And so you can kind of help to paint a vision for why incorporating this and taking, the bold move to be one of the first movers to try to do something novel and unique on the back of an emerging but not small industry, right? This is still a $1.8 trillion asset right now, right? It's hardly this obscure thing anymore. Some of these politicians that are really looking for ways to make change and to nudge the course in a different direction, because states have the same problem a lot of individuals do. States don't control the currency, so they're the recipient of the outcome of the monetary policy.
Yeah.
So they also have to look at ways to protect. And what you're trying to do is come up with as many ways as possible to make sure that value and wealth is retained within your state. You don't want capital flight. You want companies to want to domicile there. You want to bring products that you can bring that generate the revenue that the state needs to do the infrastructure projects to make it a desirable place to live, right? Like they're looking for a lot of those solutions. And so you can't just go hit them over the head with, government's bad, end the Fed, right? Like that's not the way to talk to these guys. You've got to work Bitcoin in as productive solutions that they can grasp, they could see a tangible benefit to, and then ultimately they can stamp their name to as someone who pushed something novel forward that made a difference.
Yeah, you don't need to teach them how to split the atom.
No.
You just need to teach them how to plug in.
If I got 2 hours with them, I'm not going to walk them through setting up the multi-sig and, no, it's not going to happen.
Right. It's tricky. And this is complex stuff. And especially you see if you just think everything's crypto, you just type in crypto and you see the degens online that are, max leveraging on Hyperliquid at 50x and getting liquidated. And, all of the videos of people wanting to throw themselves off their balcony is what gets all the views. So you're like, it's easy to get lost in crypto and say like, this is just bad. Like, I don't want to do any of this, but the Bitcoin conversation is fundamentally different.
Yeah. But I think you got to look at the asset and you have to acknowledge this is kind of V1 of how it enters the markets. And the first thing that's always going to happen in an asset like that is who's going to show up? The trading firms, right? Because it's not big enough that it's not susceptible to being moved around with large amounts of capital. It's still got the adoption curve in front of it. So you've got this long growth trajectory. So it gives them this avenue to trade. It was the same thing that happened with the convertible bonds with Strategy, and how all of a sudden those were, the largest convertible bonds being issued. And they were the ones that were the most competitive with the best terms that the company was able to get, was because it was a unique and novel structure on the back of a really volatile asset. Volatility is really valuable from a trader's seat. And because of that, they're going to use that volatility as much as they can. And I think now you're seeing it get, almost overused at this point. I think there's so many people harvesting volatility right now that it's just sort of throwing a wet blanket over top of it. But as that volatility starts to draw down on a temporary period of time, the incentive shifts, and that's no longer the trade, and that'll take that pressure off of it. And then I think you see Bitcoin reset higher again. But you're in this first phase where when people look at it, they go, is the real utility of this asset that it's great for trading right now? And you go, in the early days, kind of, when you're getting into the traditional financial markets. That's what most of the capital is looking to do. It's looking for a home to generate returns. And when Bitcoin made its way to Wall Street, their eyes lit up because it moves like crazy. They can do all kinds of trades. I'm sure there's all kinds of shenanigans to nudge price and incentivize it. And we see all of a sudden you've got 1 week where now Zcash is the hedge against Bitcoin for some weird reason. And then 1 week later, you've never heard about Zcash again. Right? Like these narratives come out. And so it gets caught in that environment for a little bit, but then it reaches the escape velocity because you start to create these products that are more broadly applicable, that are getting into the credit markets, that become more systemic. And then it starts to really ingrain the asset and the derivatives around the asset into the economy. And that's a massive shift. That's the 0 to 1 moment for an asset like Bitcoin. And I think you're starting to see that. And I think in people's mind, when they start to understand these types of products and these types of services that are going to get built around them, that's when it starts to become real to them. Because I think right now they just see Bitcoin, and then the next word in their mind is speculative, right? It's a speculative asset. Everyone told you that forever, right? People just speculate on it. It's a get rich quick scheme, like that was the narrative that was out there forever. And now you're starting to see structured products tailor-made to solve problems real people have. You know what problem every person has? The ability to make more money. And if I've got idle money and I can park idle money in something yielding 10% or 12% or whatever it is versus the 2%, and I compound that difference out over 10 years, that's a massive difference in position at the end of 10 years. So like now you're taking, yes, that volatility is really attractive and it still can be used for trading and the big institutions can continue to use it. But now we can harness it a different way where it becomes really applicable to you as someone who's managing your personal treasury, your corporate treasury, whatever it may be. It's starting to evolve. And that's when you're going to start to see it really get ingrained in the system. People are going to start to understand that there's value to it beyond what they've heard about people, YOLOing their, weekly paycheck into things trying to get rich in the crypto ecosystem.
Yeah, there's. Go ahead, Mason. You got something?
Well, I was wondering if Dan had anything else. We kind of got derailed.
No, I think that was a good convo.
The one other thing I want to hit on is, and I was chatting with my buddy earlier today. He called me. He was like, "What's going on with MicroStrategy?" And we were talking about valuation concepts of, at different points in time it's high, at different points in time it's low. And he actually runs his own small business. And I was talking to him. I'm like, okay, what if your business was mark to market every day, 24/7? And some days your business would be valued at $0. And he chuckled, like he couldn't stop laughing. And he's like, absolutely. Like my business would some days be valued at $0 and some days it'd be valued at $1 billion. You'd think your company's going to be around forever. And that concept was pretty eye-opening for him. You've got this infrastructure that's just mark to market every day, 24/7. Like what it's worth, like in the market, what the value of the equity is worth in the market, but the true value of like the infrastructure and the vehicle and everything that's building, you can still have a different perspective on what that's valued at into the future. And I think it's helpful to just continuously compare these to the rest of the market and everything else that's out there. This is why I continuously look at it every single day. Strategy being what's like the 220th largest company in the US stock market. It's probably like 500th in the global stock market, and yet they have more Bitcoin than the entire Mag 7 combined, multiplied by like 30. And so if we really think this is a true store of value, and other companies will start to adopt even small bits of this as a store of value as banking infrastructure gets built, etc., they're going to have a tough time catching up and storing their value if they start to become a little bit more of balance sheet companies as opposed to cash flow companies.
What do you guys think of them buying Bitcoin aggressively down here at these MNAVs? And I'll preface this by the first chart that Jeff showed of the distribution rate of Bitcoin.
Oh, yeah.
Can you pull it up?
Yeah.
I think it's interesting to look at, right? Strategy right now has 670,000 Bitcoin, right? And if you zoom in there, the remaining Bitcoin supply unmined, in 2028 is 800,000. So for the rest of eternity, the amount of Bitcoin to be mined is 800,000. And if I was a betting man, I would guess that Strategy has more than 800,000 Bitcoin by then. And what is like what does that actually mean? That's what I've been pondering. But back to my original question, what do you guys think about them adding down here?
I think it's a really good tactic because, I mean, during 2022 and 2023, I was talking to Dylan and he was saying, like, we all forget, but they were hitting the ATM during 2022 and 2023 to buy Bitcoin at like technically sub MNAVs, but like it was more complicated because the enterprise value mattered a lot at those lower valuations. So like this isn't something that's, you know, unheard of. But then two, like you actually have a lot less MNAV collapse risk down here. So if the market's buying it under $1, under one MNAV, why not? Like if the big institutions, the big players, why not have, and there's, you know, massive liquidity in the equity, why not put a huge bid on Bitcoin while it's low, expand your collateral base, you know, it's healthy for the Bitcoin market, use the liquidity and volume which you've developed in your equity, and then all the while expand your capital stack and your collateral base so you can issue more prefs in the future when and as demand continues to increase. So I don't think it's detrimental in any way, shape, or form, unless like, you know, they were doing it at MNAVs sub 0.9 or something like that.
Yeah, I would agree with that. I'll say that I was a little surprised at the scale at which
Me
they
too.
started raising. I mean, that definitely caught me off guard.
Somebody tapped me on the shoulder in Abu Dhabi, like, "Hey, strategy is about 10,000 Bitcoin." I was like, "What?
Yeah, you could have told me. I was like,
Where?"
10,000.
Wow. Someone asked me how, like, they were like, "Oh, what's your guess? What's your guess?" So I was like, maybe like 100, and then 10. It was 10,000. Now I was like, I feel like an idiot.
Yeah, and now you get the speculation running, right? Like, does he know something? And so he's trying to Dan's point, expand that collateral base while it's effectively a neutral raising tactic at the moment, right? Obviously, they still have a positive MNAV from an enterprise value perspective, but I think what a lot of people are focusing in on right now is the market cap relative to the Bitcoin NAV. But I think Dan probably nailed it. I think it is more of a play on expanding that collateral base at this point in time while you've got the advantageous prices and you build that balance sheet. It's going to give you massive capacity to be able to raise through the prefs in the future. So you can really put the gas on here, particularly if they're having conversations where they're getting massive demand. I mean, one thing that can happen with these that I don't think a lot of people really understand in the background for how this stuff can work is people can just reach out to you asking for massive chunks of a security.
Yeah.
Right. It's called a reverse inquiry. And they just come to you and someone could go to strategy and go, I want $1 billion of stretch. And they'll say, you know, what pricing they're willing to take it at, and strategy can decide yes or no. And so it's possible that they get a huge amount of demand for that for some massive block that would have to come at a discount, which they don't really do, right? That's not really their game, I don't think. It doesn't seem like they do much of that. You're not seeing it shown in the figures. So I think it's just pure ATM market price, what they're doing. But I wouldn't be surprised if they're starting to see that type of demand come through. And if it is, then they know that they're going to have the capacity to issue a significant amount of the prefs. And so at this phase, they want to scale up. And then any increase in Bitcoin is going to expand that balance sheet in a massive way and give them huge capacity to put amplification on. So it puts them in a better spot here in the future to keep this rolling in a big way. So that would make sense to me.
And it can also come in on the common equity as well. Blocks can come in at any time.
Yeah.
And they may not want it to hit the tape. They want it to happen behind the scenes, whether it be block dark pools or somebody, you know, wanting to rebalance their exposure in a ETF or something like that. So yeah, keep going. Go ahead.
So they might have just got the order, is what you're saying. Like that abnormally large purchase last week or whatever could be
like, several. Yeah, could be 4 $250 million block trades.
Right, that makes sense. Yeah, you might as well take that.
I mean, they've got the volume to support that kind of a raise all the time. You saw it when they built the reserve, right? And they only used, what was it, 4.6% of the weekly volume.
Mm-hmm.
And they raised $1 billion in a week. Like, they've got that type of volume to just do it as a normal course of business here. So
one thing that's just been continuing to blow my mind and is just the liquidity. Like, this company has been a top 20 publicly traded company since October 30th of 24. Like, that's insane. The company is ranked 220th largest US company, but they're the 19th largest by volume. Like, make that make sense.
I mean, I think I like that Tom Lee. I really do like that Tom Lee kind of talking point he's got on repeat now, that the MSTR market is, or has been over the past year, the most liquid options market related to Bitcoin in the public equity space, because the IBIT options market was just, quite frankly, not liquid whatsoever. So, a lot of the hedging pressure, especially with the advent of the ATM and the massive ATM issuance, anyone who wanted to hedge aggressively was able to get cheap borrow, right? It's a very, very cheap borrow on the stock, and had an options market that was extremely liquid. So couple that with all the traders, the gamma traders, the delta hedgers. I mean, it's a playground for anyone interested in Bitcoin's volatility. So I would say it's, structurally important to the Bitcoin ecosystem. And I like that point that Saylor said at Mano, that was like, we'll keep buying, or we'll exhaust the sellers by continuing to buy. It was something along those lines.
We can buy more than you can sell.
Yeah,
but we're going to keep buying until the complaining stops, or something like that. Wasn't that one of his posts?
Yeah.
But he's becoming like structurally important, right? Like, there will come a point at some point where, like, this does flip the whole. Like, if he gets to 5% of the supply and 6% of the supply, and like there comes a point where this is structurally relevant to the entire Bitcoin market, and he's really leaning on every lever he has. So kudos to him.
I also think, from like a sentiment and narrative perspective, buying this much Bitcoin down here from maybe an outsider's perspective who maybe isn't in the weeds, I think there is something to buying it at these levels, right? And I think that post, the buying will commence until the complaining stop. It is kind of a nod towards that they are buying regardless of the price, and it's not a price thing. This is accumulation.
I'm not going to let them totally off the hook on a lot of this, because I do also think that there's a downside to the level and frequency of transparency that Strategy really set the trend for. And the downside to that is it forces an investor base to reflect on new news and new information every single week and try to draw new conclusions every single week. And that incentivizes short-term behavior. So everyone had kind of got comfortable with the fact with Bitcoin, it's going to go up, it's going to go down. You got to take a long time horizon on this. A short outlook is 4 years. You should really be looking much further out than that. People were comfortable with that with Bitcoin. But now with equities fully capitalized on Bitcoin, they're trying to have pivots happen every week based on whatever the trading's doing that week, right? It's incentivizing really short-term thinking from an investor community. Whereas in a traditional company, right, you get information once a quarter. That's what you're digesting. That's when you get the financials. That's when you see the standing. So like if Strategy, for instance, was doing all this raising throughout the quarter and nobody found out until they released their year-end financials, and then all of a sudden you're going, oh my God, look at how much Bitcoin they bought. And if it's a net positive number, you got a positive yield at the end of it. I know right now it's a negative yield. Like, you can smooth out a lot of noise and continue to execute there. But right now what's happened is they've put themselves under a microscope. And I think that's good, right? I think that it brought a level of transparency, but it started to change. Oh my gosh, I'm just looking at that ramp up. That's crazy. But it causes a change in the behaviors of investors. A lot of, people are looking for you to make changes based on 1 week of stock performance, or 2 weeks of stock performance, or 1 month of stock performance. And that's not what these companies are structurally built to do. And if the companies are run well, they're here to weather volatility, right? I mean, they're structured in a way where they're low risk. They've got capital to continue the operations. They have sound balance sheets. If you don't have yourself in a position where you've taken on unfavorable debt terms that leaves you with some type of collateral trigger or margin requirement or something like that that causes an issue for you, you can ride out these periods. And if your thesis is that Bitcoin is going up over a long period of time, well, then that company that's putting on a long-term carry trade, Bitcoin relative to the US dollar, is going to win over a long period of time. But you have to be willing to allocate for that. I've even seen plenty of criticism for us around the strategy stuff going, how can you still be bullish? It's way down. You guys can only do this because your entry point was so low. And you go, well, yeah, that's the point. We bought a long time ago and we've been sitting on it ever since. And so you can ride out these ups and downs because you're watching the long-term thesis play out, and the things that we thought were going to happen have started to happen now. And you're starting to see
You're like, oh my God.
I don't think people are understanding what's developing in front of them. They're just focused on the value of that asset. They're ignoring the entire ecosystem that's being built up around this, the other businesses that are being built that are going to be dependent on that as the core infrastructure for it. Like, I think they're missing that completely. And they're just looking at, how it's trading relative to its MNAV. And I think in a year or two, that's going to be a totally irrelevant conversation for the companies that manage to emerge into something bigger than what the industry has been right now.
Yeah. I've been talking about MNAV for years now.
It might be your fault.
I know. I think it might be my fault, which, damn it. Because the main reason I looked at MNAV was to try to compare it to other companies in the equity world. Because
I think you were comparing it to, or it came around with the ETFs, didn't it? Wasn't that when it really got popular?
Yeah, around the ETFs it got popular, but also it was interesting for me to compare to like price to book ratios of other top 10. When I saw Strategy, I immediately thought like this company is going to be the largest company on the planet. Back when they held like 100,000 Bitcoin, and here they are, and all this infrastructure is being built. I still have that same thought. Like I think they're going to be the largest company on the planet, and like how do you value that? Like how do you value the company that has the most money? And if all equities are forward looking, there's got to be some sort of multiple that you put on top of it, but you can only compare that multiple relative to other equities in the market. Like at the end of the day, the only thing that you can compare that's homogenous is market cap. Like all of the other companies in the entire market have like completely different financial structures, different cash flow, different revenue, different industries, different businesses, different leaders. And it's all just so different. So then you start to think about, well, market cap is really the only way to compare like the Mag 7 or the elite companies in the world. You're like, okay, is Nvidia worth more than Apple? Yeah, sure. Like make the multiples make sense. You can't compare. You can look at all of the multiples on the entire industry and see like how that number is kind of trending, but like you can't compare any of this other stuff with the exception of market cap.
That's why it doesn't really bother me at the moment, right? Like we're in the infancy of this entire sector of the market, right? Most of these companies haven't really achieved real scale yet, been able to really get products out there deployed that they're able to scale their business alongside of. So outside of strategy is kind of the one that's, far and away ahead of everyone. I don't think there's probably a way to catch them, although a lot will all be trying. But when you look at where this is evolving to and everything being built around it, like there's a mass amount of value creation that's going to come out of these corporate structures backed by Bitcoin that I don't think is getting much appreciation or attention in the broader market. We live in a tiny echo chamber, by the way. Like what's happening on X, when you watch your X feed, you probably see 20 people talking on there most of the time, right? So it's like this small echo chamber that we're all plugged into that's just hyper focused on this one obscure sector in the market that most people have no idea even exists. The number of people I've talked to just this week, and I'm like, yeah, well, like Strategy, they got like $70 billion worth of Bitcoin in the bank. So like, I've never heard of it. I'm like, oh my gosh, like it's all I've heard about for a couple of years now. Like that's the world we live in. So within that, also means that you likely have a fairly small investor base that's being active out here. Really, you're seeing a huge amount of institutional capital that's found these plays, that understands the volatility around these plays, and they're doing the vast majority of the trading out there. You know, we used to have this view that we thought in the early days that strategy was likely primarily driven by retail investors. I have a totally different perspective on that now. I don't think that's the case. Look at the volumes. There's just no way. Even back then.
Yeah, it's
right?
$3 billion
Volumes were
trading
so
a day.
huge.
That's not retail.
No. And so what's happening, you know, with the retail market trading on working with the derivatives and buying the spot, like maybe on the super micro caps when they come out initially, maybe. But even then, right? Even then, it's a huge amount of institutional capital. They were the participants in all the capital raises, so they were the major holders in these equities. As soon as they hit the public markets, it was like all institutional capital. And even on the rotation of that capital, you get a lot of institutions that come in immediately after one of those events, and they buy when things are at depressed levels, and they start participating in that market. Now they've got the ability to use the volatility. Like it's a different type of investor than we all originally thought it was, which can only come with, you know, being able to kind of see behind the scenes and watch more of these play out from inception, right? With strategy, they were a little ways down the path before this started getting any real coverage. But now we're looking at what happens if you organically stand one of these up.
Yeah.
What does that structure look like? Who are the market participants? In what size are they playing? What type of terms are they looking for, right? And then you see after the fact, when it's just trading in a steady state, who's still in there. You start seeing those 13Fs come out. You start to see who's holding all of these equities, who's the market participants here, and in what size. And you quickly realize there's a lot of institutional capital that realizes there's value here, even in the small plays. The volatility is valuable to them, whether it's up or down, right? They've got strategies for both directions. And they're going to continue playing that game because this is a very unique market with equities that are specifically structured to have more volatility than Bitcoin itself, which means it is a trader's playground.
You can have all the algorithms bouncing between all of the prefs and the small Bitcoin treasury companies and strategy and Bitcoin and the options market and hedging and dynamically in all these different locations. You could just
a million pair trades you can put on now. There's arbs between all the different products you can put on now. Like this is becoming a pretty big ecosystem.
Yeah, absolutely. One, go ahead, Mason. I'm going to pull up a chart.
Yeah, I had Ben, what you're really speaking to, or at least the part about strategy's transparency leading to investors to continuously thinking about their investment, maybe reevaluating. It has its pros, it has its cons, but what I've been really thinking about is we're kind of like the first generation of social media native investors, right? I think that epoch in history started with the Wall Street Bets, Reddit, which
big idea.
Jeff was a part of, like I was a part of, and in some ways, I'm sure Ben was in there. Dan Hillary, I don't know, maybe driving a boat at that point, but what I've been really thinking about is is social media, and a really good quote I heard today was, we now have freedom of speech, but we might not have freedom of reach, right? And what that's really talking about is the algorithm, the bubbles in which we live in, and Ben was referencing the bubble in which we live in, but on social media, you really create your own bubble in that it's showing you the things that it thinks is going to make you stay there the longest, and usually that's negativity, and usually that's things that, you know, instinctually as humans, it makes us fearful, and we're more likely to react to it. It's like if you get if someone says something mean about you, right? You're way more likely to focus on that than any sort of compliment. So the algorithms really deeply want to scare us. And when you mix that with, you know, a mission of long-term investing, of holding something for 10 decades, in some ways you're making it unnecessarily hard, right? And in some ways it might not be sustainable. So that's something I've really been starting to ponder.
I've had it on 3 separate occasions that I can specifically remember where I'd went out, did my whole diligence thing, came up with a thesis that I thought was pretty rock solid, made an allocation, and then I started seeing noise on social media about the stocks. And I exited those positions because it started to just, give me too much doubt about it. Like, maybe I'm blatantly missing something. I don't know what it is, but like, I'm just going to go on the sidelines for now. And then within 3 months, the thesis played out entirely. And I was sitting on the sidelines because I let noise from, anonymous accounts on the internet, shake me out of that position, which I never should have, right? I had a thesis that was a longer term thesis. I was willing to sit on it until I got on the internet and just started reading all these panic comments. And you quickly realize that if you're going to be effective, you've got to be able to detach from that. To your point, it is the negativity that gets the engagement. And that gets it amplified. I even see it with the personal stuff, right? If someone wants to go out and chirp me about something, right? That's what gets bubbled to the top of the algorithm. And you got to go, like mute whatever's chirping you so that you don't waste your time chasing, mean comments on the internet around when you got things to do. But like, that's what bubbles up in the algorithm. So you've got to learn the difference between being willing to do your own due diligence and form a thesis that you're willing to stick to long term. And in doing that, you can use social media as a great tool. There's a ton of research that happens out there. Sometimes the accounts are hard to find, but you can find them after a while. I mean, Dan's found a ton of these, obscure small accounts that are putting out pretty good information that, he reshares every once in a while. And so if you use social media like a tool and not necessarily as I'll call it a conviction community.
Yeah.
All right. You can't do that because everyone's starting from a different position than you are. They've got different capital levels than you have. They're putting a different percentage in each trade, right? They've got different cash flow than you have. And so like their ability to get nervous about something is different than yours, but it's every bit as loud because you don't know. You don't know if that person has $300 in something or they've got 3 million or 5 million. Like how many people have you met from Twitter that are making just these massive investments in things that you would never guess, right? You don't know. And so you can't filter and weight those responses because you don't know what that individual's circumstance is. So I view it as a great way to fast track research into equities. But once I decide to make an investment, I'm basically shutting it off. I'll mute the tickers for things that I own. I'm not going to follow it because I don't want that noise. I've got a thesis. I'll watch the financials myself and keep an eye on things that are happening. Like that I'm willing to do, right? That's a part of me managing my portfolio. I can use it in the exploratory phase, but I can't keep and build my conviction around that. That doesn't work because then you abandon your thesis much too early. The reason why we've all been able to, for the most part, hold our strategy positions from way back in the day is the thesis is still playing out that we all built on. And over time, this is a learned and practiced skill, the social media thing, right?
Yeah, nothing's changed.
Oh man,
Nothing's
it goes
changed.
through waves, right?
Yeah.
Like sometimes it's great and people like you and they like to, pat you on the back. And then the next day, oh my gosh, right? It turns on a dime. And the biggest thing that I think that this group I would give a lot of credit to is the consistency to just continue showing up through every phase of that market cycle all the time, because the thesis still hasn't fully played out for us the way we've been talking about it now for a couple of years. And that's still developing. And so I hear all the noise. I watch the market price. I don't love when my portfolio goes way down during these. It sucks, right? It's not great. But the thesis is still playing out, and everything I could have possibly hoped to happen to open up the gates to allow this to truly materialize and generate a mass amount of value, that's still in front of me, not behind me.
Yeah.
Which is why I'm not going to get shaken out of these, right? People can be upset with the model and say that they don't like them. They have a different thesis than I do. My thesis is I want to collect this capital like my life depends on it. because I believe that this is playing a significant role in the future of finance, and I want to be a part of shaping that. And to do that, you've got to be able to block out noise and just execute on strategies for a long period of time.
Bingo.
Sometimes that means sitting and doing nothing, and sometimes that means moving incredibly fast. And it's all just dependent on where you're at in any given week and where your company stands. So
I've got to stop you right there, because this is a perfect place to say that we have a True North Inside event happening in February at Strategy World, Monday, February 23rd. If you want to come out and come hang out with us and talk about strategy, this is going to be an exclusive event where we plan to have a lot of fun. This will be very interactive, about 4 hours of content and interaction, plus a networking event that will happen in the evening, where there will be food and drinks and everything. So please, if you're interested in a intimate event where you get to interact with us and our team, and likely some of the strategy folks, I think we'll have some special guests there as well. And it will be a great time, and we'll have a great night, and look forward to having people there. So if you are interested, this is on Luma. We will put the link in the chat. It is also available on the MSTR True North website. If you go on events, there's an events tab, and you can see MSTR True North Vegas in partnership with Strategy World 2026. And there's all of the links down there. So there are different tiers of tickets. There are only 4 left of the first tier, and we will move on to the second couple of tiers here over the next few tickets that are sold. So boom, come join us. I'll kick it over to Mason. Back to you.
Yeah. Last thing to add is the financial incentive by large institutions or anyone in the market to scare the shit out of retail
so high
via bots, via whatever. And in the world of AI, the marginal cost of this is zero, right? You can send a million different negative messages all the time. And it's really effective. So I think it's just something you have to be conscious of.
Yeah. I'm going to share a couple more. 100% agree with you, Mason. Like this is exactly what happened with Wall Street Bets, with the GME craziness. It was very clear as that blew up. Like the Wall Street Bets thread went from 600,000 people to 10 million people in like 2 days, and it was very clear that all these bots were coming in with brand new accounts and bear posting on everything. It was crazy how quickly it was infiltrated once they recognized how in deep of a position that they were. So that can continue to happen. That will continue. We've seen it. Like we've seen.
It's the reason my posts have verified users only on them still, right? Because we went through that weird period where there was just
it was brutal. It was like
them.
Disgusting.
And because we had just entered the public markets, we were apparently one of the tickers that they were spinning up around. It would just be hundreds of them. And it's, it's bear bots, but then it's also threat bots.
Yeah. That like literal death threats. Right? And
death threat bot.
Yeah.
Tons of them.
That's so fucked up.
Tons of them.
Totally.
Yeah. It was a big deal for a couple of weeks. And like it becomes a real issue. And then there's also, people out there that are, unstable, I'll say. I had some weird experiences, right away when I took the job and had some weird things happen, but won't get into that tonight. But yeah, it's real. Like what happens out there is real. You don't really see it until you're all of a sudden the target of it for a period of time. And then you go, what is happening? And you got to find ways to shut that down and minimize it as best you can.
Completely agree. So let's go back to a couple graphs and think about valuations a little bit. I pull up this chart here. This is S&P 500 price to book value, which is the blue line, and the S&P 500 PE ratio, which is the green line. And I think this is a fascinating perspective, just seeing the divergence here and Guru Focus sends me ads all the time. Seeing the divergence between price to book and the PE ratio. So it's effectively saying the multiple is increasing over and above the balance sheet, but the relative earnings aren't increasing. The price relative to the earnings is not increasing. just an interesting phenomenon to watch play out. You look at 23, 24, there's a lot closer multiple between the PE ratio and the price to book ratio, effectively like the strength of the balance sheet. So is this overheated? I have no idea. Is there going to be a bigger focus towards balance sheet in the future? Do these multiples contract on balance sheet multiples? Who knows? But just an interesting data point to look at. The MNAV of the entire S&P 500 is 5.5. The PE ratio of the S&P 500 is 28.8. Strategy's MNAV is 1.1, and their PE ratio is like, I don't know, 6 or 7, something like that. Maybe a little bit less now that Bitcoin's down a bit. So I don't know, maybe it's like, or maybe it's more, probably maybe it's 10 or something like that. But it's still significantly lower than the rest of the market. The other thing that I thought is interesting, I've been looking at some of the smaller Bitcoin treasury companies, and I won't name names, but I was looking at companies that are around $750 million and looking at other companies around that market cap to look at different balance sheets and different financial structures of some of these smaller micro or small cap companies and how they compare to some of the Bitcoin treasury companies, thinking about balance sheet strength and revenue, et cetera. And one of the ones that came up here that was just interesting to see is like Krispy Kreme donut, right? Krispy Kreme donut is a $750 million market cap. And just for fun, I'm like, let's just look at their balance sheet. Let's see what Krispy Kreme looks like. And
what's their donut MNAV?
Their donut MNAV. So actually, funny enough, their price to book ratio is 1.1. Okay, so you could think of their MNAV as being 1.1. And so then I was like, okay, that's interesting. You can look at the total assets. You're like, wow, you've got $2.6 billion of assets, right? Let's do a little bit of math. You got $2.6 billion of assets. And you've got, on the liability side, total liabilities, you've got $1.9 billion of liabilities. Okay. So you've effectively got about $700 million of net assets, which makes sense. And then I was like, well, what are Krispy Kreme's assets? Like, you got 700, like what is this? What is Krispy Kreme's holding $2.6 billion of assets? Let's dive into this a little bit. Like what makes up the assets?
Sprinkles.
And so I looked at the financials, and this ended up triggering an analysis into a bunch of these small cap companies, and I've got a bone to pick with most of them. But okay, so this is their 10Q. This is the most recent quarterly balance sheet report. So you could see in here the total assets, $2.6 billion. And you look at their cash and cash equivalent, $30 million. Okay, so that's their liquid cash. It's $30 million. Accounts receivable, $53 million. Okay, so you're like, okay, on line 3, you're talking about credit risk. You got $30 million of cash. All right, and you got line 3, $53 million. Now you got credit risk. Then you've got inventory of $28 million. It's just sugar. Taxes receivable, $19 million. Prepaid expense, $29 million. You're like, okay, the current assets is $161 million. Now, where this gets a little weird is the second part. Goodwill. This is the part that really pissed me off. Goodwill and other intangible assets make up $1.5 billion. Okay, let's think about how crazy that is. What is goodwill? Goodwill is like if you acquire a company and you pay more for that company than the market cap of that company, that delta is technically considered goodwill. So that's intangibles. It's like brand value or an email distribution list, or it's something that is not liquid. It is an illiquid thing that you can count as an asset on your balance sheet. Okay, that's crazy. And then you have this other line, which is other intangibles. What the hell is that? That's $800 million. Right? What is? You have $800 million of other intangibles that you're counting as an asset on your balance sheet? Well, that's crazy. And then and then you've got property and equipment. Okay, that's valued at $491 million. That's not liquid, right? If you wanted to sell that property, like who's going to buy the Krispy Kreme donut shop? Like maybe Chick-fil-A buys half of them, and then the other half, like maybe they sit vacant. Who knows? And then what about all the equipment? Like, do people want all that machinery and the infrastructure to create Krispy Kreme donuts? Like, what if Krispy Kreme donuts cause cancer and all of a sudden, boom, we're zero. So, okay, the asset side of the balance sheet, the 2.6 billion is actually, if you just pull out the goodwill and other intangibles because you're like, this isn't liquid and they're intangible, the asset side of the balance sheet goes to $1 billion. Okay, now let's go back and look at this, right? You got total assets. It says 2.6, but it really should be more like $1 billion because none of this stuff is liquid. And the total liabilities are 1.9 billion. You're like, okay, well now that price to book ratio is way off. It should be negative. Like the company is trading at a multiple of some inflated number of goodwill and intangibles on a balance sheet. Like that number is just wrong. And it's maybe not wrong. It's like, it's technically right based on the accounting rules, but you start to rethink like, what is the value here? And you look at the earnings, and the earnings are okay. On top of that, Krispy Kreme has lost $550 million in 2025. Like,
In
what
that
do you mean?
10Q, can you do a search for the
Yeah.
goodwill and intangibles and see if they itemize those out and see what's actually in there? It's got to be hilarious.
Goodwill.
Like brand value.
Yeah, there you go.
Yeah. Well,
So are they like acquiring small donut shops at a premium and rolling them and converting them to Krispy Kremes?
I have no idea. We'll have to look into this.
Yeah, we can look into it. We don't need
But
to
it's
do this here. I just wanted to see. Like
it just seems like, and I was talking with our accountants about goodwill a little bit, just because I'm just trying to get some history here. Basically, companies should take an impairment charge. Like if this is valued too high, like you can write it off. You can, and you probably should write it off, but there's incentive to not write it off. And your accounting firm or your like auditor will pretty much agree to kind of whatever you say, because they want you as a client and they can continue to be there. But the point of doing this exercise is just backing up and looking at the actual balance sheet and looking at the vehicle, like the investment vehicle that exists here with this company that's worth $750 million. Like why is it worth $750 million? It's worth $750 million because there are market cap weighted index funds that buy everything. And so when you start to compare this to companies that hold $750 million of liquid Bitcoin, that proposition starts to look a lot more attractive compared to a company that's lost $550 million. Half the assets on the balance sheet are inflated and all of the assets are illiquid. And this isn't the only place. Most of these other companies, I looked at a couple of insurance companies and a few other companies, but another really interesting line item that is generally a large number of the assets on the balance sheet is receivables, like accounts receivables. And when you think about accounts receivables, it's like, okay, well, that's credit risk. And a few companies I looked at, they had like 50% of the assets on the balance sheet are receivables. Okay, well, who are the receivables from? Are they from retail? Are they from companies? And they have to take some sort of assumption on the credit risk associated with getting those receivables in the door. So they are taking a haircut on them. Generally, they're pretty high. Like the haircut is very small. But there's so much asset value sitting on like huge balance sheets everywhere that is credit risk that might just be completely disrupted in the next 5 years. And that's being accounted for as an asset, even though it's intangible and it's not actually real and they don't actually have the money, yet it's being counted as an asset and flows into price to book values, flows into valuations. And like whereas the companies that have the Bitcoin on the balance sheet, they have the assets on the balance sheet. They are real. They are liquid. They're not intangible. The asset itself trades $60 billion a day. Like, that value proposition is so much better than all this other garbage that has all these inflated values. So,
And we also only include one asset in those valuation metrics that we're doing.
yeah,
Right? Like, Strategy's now got $1.4 billion sitting in cash. That's not going to be included in any of the metrics people are looking at, right? We just look at Bitcoin value.
Exactly.
Right.
Boys, I'm getting kind of to the end of my rope here.
Yeah. I'm still on Abu Dhabi time, so I should be asleep. Well, with that, we can end it there. And appreciate the time. If you're interested in joining us at Strategy World, please buy a ticket and come support us. It will be a good time, I promise. And maybe we'll get some sort of nightclub thing happening later in the week. I don't know. We'll have some fun down in Vegas.
Also, Jeff, we're telling people to like and subscribe.
Oh yeah, please like and subscribe. True North, the investment.
We've never done that before, but
wow, we should probably do that at the beginning.
Yeah,
smash that
2 hours
button.
deep, only subscribers.
369 people on live, I guess, on YouTube.
We're gonna have to get Tim to record another video.
Yeah,
exactly.
Well, thank you, everybody. An hour 56 in, and appreciate the time. We'll catch you probably not next week because that's Christmas. Enjoy the holiday. And if we don't have another one of these, have a happy new year, and we will see you in 2026.
Awesome.